Hey guys, welcome back to another video. My name is Josh, and in today's video we'll be talking about how you could invest well during a period of inflation according to tips from Warren Buffett. So as you know, we are heading into a period where we do expect higher inflation coming out of the pandemic. As the economy recovers, as business comes back to life, we do expect higher inflation, and businesses that perform well during periods of higher inflation might be different from businesses that perform well during a period of low inflation and low interest rates. So we'll be going over the characteristics of businesses that will do well in a period of high inflation according to Warren Buffett. I'll be also sharing with you guys the companies that I think will do well in this type of environment. So as always, this is not financial advice, purely for entertainment purposes only. You can read the full disclaimer down in the video description below. But without further ado, let's get right into the video. So just to give you a little bit of context behind the higher inflationary environment that we live in, over here we can see that markets do expect higher inflation coming along. Despite rising inflation, experts say the Fed won't budge on rates. According to this article, stocks have been tethered over the past week to rising treasury yields and the possibility that the Fed will tighten monetary policy to tackle an expected rise in inflation. What this is saying is that the market expects higher inflation, therefore the market also expects the Fed to increase the Fed rate, and what this means is that interest rates will increase. This will have a negative impact on businesses that have a high debt balance, because when interest rates go up, they have higher interest expenses, leaving less money to be paid out to shareholders. So that has caused a lot of nervousness and the sell down in the stock market. And on Thursday, Fed Chairman Jerome Powell acknowledged that some upward pressure on prices could occur as the economy reopens, noting that he expects the central bank to be patient on policy action, even if the economy sees transitory increases in inflation. So in other words, the central bank is going to sit back and chill for a bit, even though there might be inflation in the short term, as long as there isn't any disorder in the market. So as you can see here, the 10-year treasury yield has increased to roughly 1.568% from a low of around 0.5% back in August. So this does signal that the economy is recovering and people's confidence in the economy is strengthening as they sell out of bonds, resulting in a higher yield on the bonds. So as you can see, back in March during the pandemic crash, people were willing to accept a really low rate on bonds. They were just dumping everything, buying bonds. The Fed was also buying up a ton of bonds to try to stimulate the economy. But now as the economy has recovered and economy starts reopening, people are more confident. They're now selling bonds, and that results in an increase in the 10-year treasury yield. So now let's talk about why inflation is bad for stocks. And the main reason is an increase in hurdle cost. Now, the hurdle cost is made up of two costs. One is the visible cost of capital, which is made up of cost of equity plus the cost of debt. So the cost of equity is basically the cost of having shareholders' money in the business. So when you pay out dividends, or if you buy back shares, that is, money going out of the business, paying back to the shareholders. And the second one, cost of debt. So that is the cost related to borrowing money from a bank or other institution and having to pay interest. So those two costs make up the cost of capital, and that is visible in the business. We can see that an actual cost. And the second one is the inflation rate, which is an invisible cost. All right, so Warren Buffett explains this quite well. A business earning 20% on capital can produce a negative real return for its owners under inflationary conditions, not much more severe than presently prevail. So this was said during 1977, where there was pretty high inflation at that time compared to what we have now. So what he's saying is, if the company is earning 20% on capital, but say for example, inflation is 30%, then the investor is actually worse off by investing in the business, because they've only invested money and returned 20%, whereas the cost of everything else in the world has gone up by 30%. So they've actually lost purchasing power, and that is a real cost to the shareholder. So you want a business that can go beyond that hurdle cost to make a real rate of return for the shareholder. And that is why we've actually seen so much of the high-flying growth stocks and the spec stocks sell off. And the reason being is because previously we were in a period of very low inflation. possibly even deflation, and a period where the cost of money was so cheap. You can literally borrow money at close to 0% interest rate, and what that meant is that the cost of capital was very low. So the hurdle cost was really low, and what that meant was that even businesses that were unprofitable, that had no revenue whatsoever, were bid up exorbitantly, right? We've seen the share prices of some of these SPAC stocks or some of these pre-revenue stocks go up quite significantly, and now we've seen those company share prices have recently got decimated in the market sell-off. A higher hurdle cost does mean that investors do need to be a bit more selective with their stock picks, and Warren Buffett does actually give us 2 tips on picking these good types of stocks, but this is the first one here. So a business will need to earn a sufficient return on capital so that if inflation rate increases, then the company will still be making a return above the hurdle cost. So now, just to give you a visual example of the stocks that have been sold down, firstly, let's look at the market index. The NASDAQ has dropped 5.1% over the past month or so. If we look at the SPAC index have dropped off more dramatically than the NASDAQ did in the same period of time. And with these SPAC stocks, these are companies that don't really have an underlying business yet. So it does make sense that these companies are the ones selling down. And we also see companies like Tesla getting decimated in the past month. So over that same period, Tesla is down 32.29%, which is much more than the NASDAQ drop over that same period of time. Now, Tesla is a very richly valued company. This company is making very little in profits at the moment. This company does have debt on their balance sheet as well. So if the interest rates go up, then you can expect the cost of capital for Tesla to go up. Another explanation as well is because the hype in EVs are now dying down. People are now realizing, hey, we're paying so much in advance in terms of valuation for Tesla. We're paying Tesla for the company that it will be in the next 5 years. During a market correction, people are more selective with the stocks that they have, and it's usually the high growth companies, the ones trading at super high multiples, getting chopped off first, the ones dropping the most. So now, what to invest in an inflationary environment? Well, in the 1981 Berkshire Hathaway letter to shareholders, Warren Buffett tells us to invest in companies that have 2 characteristics. First is an ability to increase prices rather easily without fear of significant loss of either market share or unit volume. So these are companies that have a monopoly or a strong moat around the business, a company that has significant competitive advantages over its competitors. In other words, companies that have a product or sell a service in which their customers have very inelastic demand. So if the company raises their prices, customers will probably just have to accept higher prices, pay those higher prices, and get on with their lives. So I can think of a business like Coca-Cola, for example. If they did increase the prices of a can of the Coke from $1 to $1.50, chances are people will still buy Coca-Cola because they like the product. Customers usually tend to have strong brand affiliation with the product. So this is number 1. We want to look for those type of companies that sell those type of products or services. And number 2, we want a company that has the ability to accommodate large dollar volume increases in business, often produce more by inflation than by real growth, with only minor additional investment of capital. So these sound a lot like companies like the tech stocks, where there's basically no additional cost of providing one more unit of product or service, just because they don't really have any raw materials related to that type of product. So for example, if we're using Coca-Cola again, with Coke, if you want to sell more Coca-Cola, you will need to get a bigger factory, you need to pay someone to make the product, and you need to have a lot of logistics just to get that product to the consumer. So there is a lot more capital invested into that product compared to a company like a software provider like Microsoft, where there isn't any marginal cost related to providing one more unit to a consumer. So these 2 characteristics actually fit really well with the profile of a technology company, and you could argue that it is easier to find these companies these days compared to when Warren Buffett was writing this in 1981, just because there isn't as much of a tech presence in the market. But right now, There's a lot of tech stocks that actually fit these two criteria. And personally, I can think of 3 tech stocks that fit these 2 criteria, as well as the other criteria of having a high return on equity. And these are Google, Microsoft, and Facebook. So these are the big tech stocks at the moment. They have really strong economic moats. These companies have a really high return on invested capital, and they can probably increase their production or increase supply of their services without any additional investment required. So these are companies that will do well in a period of inflation, according to Mr. Buffett. So time will tell whether these stocks will do well. But at the moment, I do own shares in Facebook, but I do plan to add into Google and Microsoft going forward into the next month or so, depending on how this situation plays out. But even if we don't enter a period of high inflation or moderate inflation, I still think these companies will do well because these companies have a very good business model. They spit out a lot of cash. And remember, these are companies that have a net cash position. So even if the cost of borrowing goes up, these companies won't be affected. And in fact, if the cost of borrowing goes up, then perhaps their money sitting in the bank will earn them a higher rate of return than what it was before. So these companies will actually benefit from the higher interest rates compared to other businesses where they have a lot of debt, a lot of leverage on their balance sheets. Those will be the companies that will be affected the most in terms of rising interest rates. So I think these companies are well positioned to perform well in the next few months, especially as well as in the long term. Let me know what you think about Warren Buffett's tips. Let me know if you know any stocks that meet those criteria that I've mentioned in this video. I'll be keen to hear what your thoughts and opinions are. And as always, this is not a recommendation for you to buy these 3 stocks either. Always do your own research before investing. Thank you for watching, guys. Until next time, take care.